Good afternoon, everybody. Welcome back. Another couple of weeks of relative turmoil, to be honest. So the markets are busy. I think one of the markets we want to focus on that we don't always focus on here is commodity markets. There's a lot going on with commodities, with the dollar impact and all the rest of it that's going on with the state of the global economy. So let's get started here. Commodity markets are certainly nervous at present. If we look at the copper chart that we've got in front of us, you can see some of the wild swings we've had in here, some of the gap openings and the rest of it. The problem here is when we saw this move down at the beginning of the chart here on the bottom left, we saw this move on the back of China data coming out pretty weak. Manufacturing PMIs were in contraction. China exports and imports both fell for the first time in a couple of years. And obviously that sends up a balloon to the markets that there's a problem with growth and therefore demand. And demand for commodities, obviously is one of the things that drives them. Commodities are all about supply and demand. Europe and US are buying less goods as rate hikes hit. And there's a global slowdown going on. So we have to understand that, this is going to be an impactful part of the commodity story. So then we saw, woes move towards hope as China was suggested by some sources to be relaxing zero tolerance COVID policies, which took, as you can see here, copper up quite substantially. So you can see here on the right hand side of this chart how sensitive some commodities are to China reopening stories. Now, this is quite interesting. Unfortunately, Beijing did quash this rumor quite severely, saying that there was no justification in that story. And the Monday Falls we saw the weekend news move into sort of the beginning of the week, and then we saw copper down again. We fell about 3% after an 8% rally, which means we didn't give it all back, but we certainly sort of trimmed some of the exuberance out of that. So there's a couple of questions that get thrown up by all this. Is this a sign that markets are ready to turn? I think they are looking for any piece of good news out of China to sort of have that excuse to sort of get long commodities that have seen such a long drawn down run lower, because there is some climate control spending coming up, which is going to sort of add to the commodity demand from which could be strategic from governments, which is not necessarily price sensitive. And all that sort of agreement of spending the money is coming through. The next phase will be actually buying the raw materials needed for climate control and indeed infrastructure to house the onshoring of energy that's required throughout Europe. So I think additionally to that, I think the hedge funds particularly were short commodities across the board. They'd been making good money out of it because as the dollar went up, commodities were really sort of hit quite hard with the demand aspect as well. And so it was a pretty easy trade. But this market now is far more two-way, I think. And I think we've got to keep a really close eye on China policy and their economy, their policy towards COVID and the lockdowns, and their policy towards stimulating growth are really important for the global economy and therefore commodities right across the board. So these are important times. We could be nearing a crossroads. So we need to sort of see what other factors can play into these markets as well. And one of those is geopolitical events. Obviously, we know about the geopolitical event of Russia invading Ukraine. That's a given. But the impact of that is, comes onto a supply issue. Is there enough stuff coming out of Russia being allowed to, with sanctions, to sort of come into the Western world? Well, not really. But, we've seen this with grains. There was talk that Russia was halting its backing last week for grain shipments coming out of Ukraine. We saw wheat prices spike, and then Russia came back, as you can see on the charts on the right here, Russia came back and actually said they were allowing it to happen. You can see the spike down in both corn and wheat, pretty aggressive moves down. So again, you can see that demand supply issues there. They have dramatic impacts on many different commodities, and on this case, it was grains. We've seen the same thing with copper and steel and other things as well. So, will Russia's actions in the Ukraine war continue to dominate certain commodities? Clearly, yes. So we are exposed to headlines that we just don't know where they're coming from. We call them left field stories, and these stories coming out of left field could impact markets, making it difficult to trade these to some degree, particularly corn and wheat at the moment. But we need to stay alert. I mean, that is the key. You need the news stories on your systems. You need to be aware of what's out there and which headlines impact which commodities. We cannot broad brush commodities at the moment. We have very specific sectors. The grains are moving slightly differently to some of the metals. And again, metals away from precious metals also act differently. So there are ongoing European energy woes as we come into winter, although to date it's been extraordinarily mild. But Europeans are paying double for gas on a year earlier. That's hurting. So European energy bills are still going up, as you can see here on the chart, bottom left. Electricity and gas starting to move up. There's billions being spent by the EU to help consumers. That seems to be ongoing. So whether they can cap that and reduce that pain, I'm not sure. But looking at natural gas prices on the right here, they're starting to spike higher again. And that's with October being unseasonably warm and looking like November maybe as well, but winter is around the corner. So natural gas prices need to be focused on. How far will EU governments go to help consumers? It looks like Germany's pretty convinced that they will go hard on this. I'm not sure all can afford it, but it looks like they're sort of doing this it's populist politics. This is vote buying, but certain areas, certain factors within the economy do need this help. Obviously, it hits the poor hard and it hits anybody else. But this weather and seasonal demand is going to keep gas prices pretty elevated. It'd be interesting to see if Russia and the US or Europe can ever sit down and start discussing this war. But at the moment, that seems really unlikely. So ongoing Russia supply constraints, I think, is the story here. So it's going to be tough over the next few months to sort of get really short of commodities. Obviously, a lot of the moves in commodities depends on the dollar. The dollar has reestablished itself as the king of currencies at the moment. And let's not forget that commodities are priced in dollars. So it has a big role to play in this. And, it actually, because they're priced in dollars, actually nullifies some of the impact of rising commodity prices on the US because they don't have the dollar component to deal with. We saw last Wednesday, the Fed come out, became the global leader amongst central banks with another 75 basis point hike, a hawkish Powell, without doubt. So the dollar was very well bid. We've had a lot of volatility since I last spoke to you in the last couple of weeks. We did see a sell-off on Friday, about 2%, and commodities received a decent boost on that. As you can see on the charts on the right here, as the dollar index went down, you can see gold as a proxy we're using here straight up in the opposite direction. Shows you how these markets trade with just a dollar move. This was nothing to do really with demand. This was just a dollar influence, and we can't move away from just how strong this dollar influence is on commodities when there's no other news around. So keep an eye on that. I think these recent moves in commodities, there's a lot going on at the moment. We've got the midterm elections still being counted as I speak. We've got US CPI inflation data tomorrow, could have big impacts on the dollar. So, US dollar strength is to some degree going to be moved around by, I don't know when we're going to get the final results on the midterms. Could be weeks, I guess, but tomorrow's CPI data could be formative. And I think the CPI data is probably more important than the midterm elections, to be honest. It looks like the Senate is going to be a very, very close call indeed. Final thoughts on this. To me, there's a timing mismatch between forced demand, which is strategic buying from those government, meeting supply. I think there's going to be a big rush to meet some climate goals at some point. COP27 started on Sunday. There's some commitments coming out already. I think that the governments are going to need commodities for this if they are real about actually spending the money on their promises. And therefore, at some point, we could see a big new buyer come into commodities. So I think that's important. I think geopolitics, Russia, obviously in the equation, but also China. If we're going to have a bit of a ongoing spat with China and the US, there's a danger that sanctions start coming out on the back of that, especially if they start threatening Taiwan. And on that basis, then we could have further supply issues. And don't forget, with China, we still have this slow economy there, a lack of demand coming out of China. With an economy that large, it does matter. So, commodities could be under pressure through the lack of demand still from the global economy. But there again, what's going to happen with this strategic demand and the dollar? So it's a tough call here. Oil potentially underpinned by OPEC. They're looking at cuts if oil falls. And also there is Biden's made it quite clear that at some point, if oil does come off, they're going to have to replenish the SPR, their special petroleum reserve oil that they have. And that's probably around $80. So that keeps a bit of a floor under oil, and the upside looks a little exposed at times. But we've seen oil coming off again today. And I think it's one of those things that is very much a trade the range until it breaks. But oil is not easy. There's so many moving parts in that at the moment with the dollar, geopolitics, OPEC, the US SPR. So, and also inflation isn't going away anytime soon. And this sort of bid that we've seen in oil recently is not helping. Commodities could come back as an inflation hedge. Who knows? I mean, maybe we should be buying commodities as an inflation hedge, because inflation seems to be holding up extremely well. One of the biggest drivers out there will certainly be China. If they do unlock and we get this surge of demand, I think that's going to be a major boost for commodities. That could turn a lot of things, actually. And I think realistically, we could see the dollar down, yields down, and commodities up on a clear signal from China that they are going to give up on this COVID zero policy. But I'm not hearing anything to that effect from the administration in China at all yet. I think that's something for the first quarter next year. So between now and then, a period of flux. I think there's going to be very fluid markets, quite high volatility as well. So, buying and holding or selling and holding is not going to be easy. There's going to be some pretty wild swings out there. So just be careful about the potential moves out there on this. I think you're going to have to be fleet of foot, flexible, and understanding about where the technical levels sit, where you can put your stops and when you put your entry levels. Be patient. I think chasing this stuff is going to be very dangerous. So it's a tough call, but commodities are going to be very active over the next 2 to 3 months, in my view.